Take a moment and pause whatever you are doing, because the current situation in the precious metals market deserves calm attention rather than emotional reaction. There has been a noticeable shift in sentiment, and many participants are trying to make decisions based on short-term price movements rather than the broader picture. Recently, some investors have chosen to sell their silver holdings during a period of declining prices. This kind of reaction is not unusual in financial markets. When prices move lower, especially after a strong rally, uncertainty increases and short-term participants often step away. At the same time, other participants with a longer-term perspective may quietly step in to buy. At the moment, both gold and silver have experienced a period of downward pressure. Silver has seen a sharper percentage decline compared to gold, which is consistent with its historically higher volatility. Movements like this have occurred many times in previous market cycles, and they often reflect changes in positioning rather than a sudden shift in underlying fundamentals. One important distinction to understand is the difference between price activity and physical demand. Market prices are influenced by a wide range of factors, including trading activity in futures markets, shifts in investor sentiment, and broader macroeconomic conditions. These factors can sometimes create short-term price movements that do not fully reflect longer-term supply and demand dynamics. During periods like this, it is common to see leveraged traders reduce their positions. This process, often referred to as deleveraging, happens when traders who used borrowed capital decide or are required to exit their trades. As these positions are closed, it can create additional downward pressure on prices, even if the underlying demand for physical metals remains steady. At the same time, there are participants in the market who are not focused on short-term price changes. These include industrial users, long-term investors, and institutions that view precious metals as part of a broader strategy. Their decisions are often based on factors such as diversification, supply constraints, and long-term economic trends rather than daily price fluctuations. This creates a situation where two things can happen at once. Prices may decline due to selling pressure in financial markets, while physical demand continues at a steady pace in the background. These dynamics are not contradictory. They simply reflect the presence of different types of participants with different objectives. Another factor influencing the market is the broader economic environment. Interest rate expectations, currency strength, and global economic conditions all play a role in shaping investor behavior. When interest rates remain elevated, some investors may prefer assets that generate income, which can temporarily reduce demand for non-yielding assets like gold and silver. Geopolitical developments can also influence market behavior. Changes in global stability, trade relationships, or energy markets can create uncertainty, which sometimes benefits precious metals and sometimes strengthens other assets like the US dollar. The interaction between these forces can lead to complex and sometimes unexpected price movements. It is also important to recognize that market cycles naturally include periods of expansion and correction. After a strong upward move, a pullback can occur as early participants take profits and newer participants reassess their positions. This process can help reset the market and establish a more sustainable foundation for future movement. Historical data shows that precious metals have experienced similar cycles in the past. Periods of strong performance have often been followed by corrections, which can vary in size and duration. These corrections can feel significant in the moment, but over longer timeframes, they are part of a broader pattern. For those observing the market, one of the key considerations is time horizon. Short-term traders may focus on daily or weekly price changes, while long-term participants often evaluate trends over years. The same price movement can have very different meanings depending on that perspective. There are also several indicators that market participants watch to better understand current conditions. These include trading volumes, open interest in futures markets, and signals related to physical demand. Changes in these indicators can provide insight into whether selling pressure is slowing down or continuing. However, it is important to approach all indicators with caution. No single data point can provide complete certainty about future price movements. Markets are influenced by a wide range of variables, and outcomes are never guaranteed. In the near term, it remains possible that prices could continue to move in either direction. Volatility is a normal part of financial markets, especially in assets like silver that tend to amplify broader trends. Because of this, making decisions based solely on short-term movements can carry risk. Over longer periods, many investors choose to focus on broader themes such as monetary policy, inflation trends, and global demand for industrial materials. These factors can shape the overall direction of the market, even though short-term fluctuations may temporarily move prices away from those trends. It is also worth noting that different participants enter the market for different reasons. Some are driven by momentum, others by long-term strategy, and others by practical needs such as industrial use. When conditions change, these groups may react differently, creating the kind of mixed signals that are currently being observed. As the current phase continues to develop, the market may gradually move toward a new balance. This process can take time, and it often involves periods of uncertainty. Observing how different indicators evolve can provide useful context, but patience is often required. In situations like this, maintaining a balanced and informed perspective is important. Emotional reactions to price movements can lead to decisions that may not align with long-term goals. Taking the time to understand the broader environment can help create a more stable approach. The key takeaway is that current price movements reflect a combination of factors, including changing sentiment, adjustments in trading positions, and ongoing underlying demand. These elements interact in complex ways, and it is not always possible to predict short-term outcomes with precision. As always, it is important to base any financial decision on careful consideration, reliable information, and an understanding of personal risk tolerance. Markets will continue to move, and conditions will continue to evolve. For now, the situation remains dynamic. Some participants are stepping back, while others continue to engage based on their own strategies and perspectives. Over time, the interaction between these groups will shape the next phase of the market. Staying informed, remaining patient, and focusing on well-researched information can help navigate periods like this with greater confidence and clarity.